unpopular opinion, a Trump presidency is actually bearish for tech. If the social mood has shifted and it's affected the Republican Party, and if Trump does win, where there's this feeling that there needs to be more opportunities for smaller businesses, there needs to be more equality of conditions for other sectors outside of tech. Tech's going to get hit, and if tech's going to get hit, and that's been what's the sole momentum driver. We'll see, if the S&P is going to be the only game in town anymore. I don't think it is.
Michael Galliard returns to the show. He is a portfolio manager of Tidal Financial Group. We'll be talking about two important developments: the yen carry trade and the recent move in the small caps surge upwards. What does this mean? Michael, welcome back.
Always appreciate you and your phenomenal hair.
Always appreciate you and your phenomenal fitness routine. You're looking better every time I have you on. It's good to see you a couple weeks ago in New York live, but now we're back in the studio. Let's talk about the yen first. So the yen carrier trade is something you've been talking about on my show, at least quite a bit, and on your show as well. We can follow Michael in the links down below. He's got his own YouTube show. So the Japanese yen was at a 38-year low against the US dollar, and last week it surged. It's been suspected. Okay, I'm reading this article from Reuters. Japan keeps up yen warning 6 trillion yen 2-day intervention suspected. What does that mean, suspected?
It means they did it, but
Did
they
they
don't want to
do
do
it
it.
or they did it? I
Yeah,
mean,
exactly. No, no, look. So that move actually was really interesting because it coincided with the softer CPI print, but it wasn't like immediate. It was almost as if they did intervene, they intervened around the time of the release to make it look like it's because the dollar was weakening, not because of them intervening because of that softer print. I will say it is fascinating to me that you've had this surge, relative surge, not huge surge. You've had this surge in the yen, and what's been selling off is Nvidia and the large cap tech names. And I know that sounds like it's a strange link, but I've been floating this idea out on X. It's like, all right, how much of this AI momentum trade has been driven by the carry trade, the idea of money that's been investors that are borrowing capital from Japan at basically nothing rates and then deploying it into the hot stocks of the moment. So yen comes back up and Nvidia and all the AI names fall. That seems suspicious to me.
okay, you've been talking about this carry trade risk for quite a while. They finally intervened, so your instinct was correct there. But did it have any significant impact on the U.S. Treasury market?
No, not yet. And that's the big fear, obviously, right? Which is that if Japan panics, as I suspect they will be forced to try to save the yen, what does that mean in practice? They only have, one of two options. They either raise rates aggressively to close the gap against US rates. Good luck trying to do that. Or they literally buy yen with dollars. But if they don't have enough dollars, how do they get more dollars to buy up yen to support the currency? They have to sell treasuries,
Yeah.
right? So I have to pause for a second. So the point is that that is the fear that you're going to have a treasury dislocation because of what may be coming down the pipeline in terms of Japan's actions. My thesis has always been that if that happens, that's going to cause a broader panic in other assets, which then brings money going back into treasuries to basically sop up the supply that Japan unloads onto the marketplace. I still think this is coming. This whole reverse carry trade, which I started bringing up on your show for the first time in August of last year, is contingent upon the idea that the yen has a successive number of weeks where it keeps on appreciating, such that it causes investors that have borrowed yen to be worried because of recency bias that the currency is running away from them, that their liabilities now are going to be more costly because they have to convert back to yen to pay off the loan, and that forces them to sell assets globally. All right, it's not some doom and gloom type of thing. It's a mechanical margin call that takes place if you have a successive period of yen strength. We haven't seen it yet. I still think it's coming.
So it was at 162 at its lowest point. The U.S. The yen to USD pair. Now it's at 156.9. Substantial appreciation over the last week. Is it over, you think? Is there more upside to go for the yen?
Yeah, I mean, if I were a currency trader, I would probably buy the yen here because I'd be betting on the short squeeze, right? Which is that the yen over a successive number of weeks rallying. Um, I think it's important for people to realize that currencies, when they move, they're not supposed to move violently. But when they do move violently, it can have all kinds of reverberations, right, on global markets. There was a headline that came out the other day as far as exports from Japan, and they came in much weaker than anybody expected. That's despite the yen being weaker, right? A weak currency should help their exports. It hasn't been the case at all. So I keep going back to what's the risk for Japan? The risk for Japan is oil priced in yen because they import all of their oil. If they're not getting any real commensurate increase in exports and they have to keep on importing oil priced in yen, they better do everything they can to bring that oil priced in yen lower, which means they have to force the yen higher.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Okay, so ultimately, what does this mean for us now, Michael? We live in the West, you and I, we're not Japanese. Why do we care? Why are we talking about this?
So the implication, first of all, could be monumental for treasuries, right? Number one, just because, just momentarily, in terms of them mechanically selling. But the broader point is if the yen were to start appreciating pretty significantly, and if I'm right that there is a link between yen weakness and Nvidia strength and AI momentum and Mag 7, that was the carry trade and the reversal of the carry trade then happens, it means that all these mega cap tech stocks that went vertical because of that borrowed money, at least partially from Japan, starts to sell off, right? And potentially sell off in a very aggressive way. It's not some weird like conspiracy theory or me trying to hope to be right. It's just odd to me that the yen appreciates, and that has to be around the time that all these AI stocks start to break.
Yeah, that was the same day. Let's talk about that day. That
Yeah.
was July 11th. Okay. That was exactly a week ago. I know what happened. The CPI print came out. The probability of a Fed cut by September spiked up to 85% on that day. And on the same day, the small cap started to rally. The Russell
Yeah.
just shot up in a straight line. Let's talk about that move.
Yeah, so it's fun. You're hitting on something which is really important, which is that everything is interconnected. Okay, so you have this very sudden break. So okay, let's go with that theory. The yen appreciates, somewhat of a reverse carry trade dynamic causes some forced selling at the margin in the large cap tech names. For a good year and a half, there's been this I think spread trade that's gone on, especially among the hedge fund community, where they short small caps and then effectively dollar for dollar they buy large caps. They're playing the differential. Large caps have gone up and to the right. Small caps have largely gone sideways with a bunch of chop. So if you're trying to neutralize beta, neutralize the stock market, why not take less risk by shorting small caps and then taking those proceeds and going long large caps? Suddenly, large caps have a sell off. That spread trade goes completely against them, and small caps have this huge, what looks like a short covering rally because that spread trade now is going through like a Six Sigma type of event, right? And it's persisted. Now, the narrative out there is this is the start of small cap relative momentum. I would love to see that. Like, I actually would love to see small caps outperform. I've been highlighting this idea that small caps hold the key for a better part of a year because the market, and when I say the market, I'm talking about the vast majority of stocks, which are small cap, have not done all that well relative to the Mag 7. The issue for me is that the way that what if I'm right about the spread trade, the way the spread trade has unwound is so aggressive that it's very reminiscent of August of 2007, where in August of 2007 you had a lot of quant funds effectively blow up because they were doing long short trades that went through multi-standard deviation dislocations. If the small cap move is real, there's a lot of potential for it to be real from a very long-term perspective. If this is more of a mechanical short squeeze that caught everybody off sides with small caps rallying and large caps catching down, then there's a deleveraging that's still coming as a lagged response to the pain that these hedge funds are now going through.
I've heard some similar theories than what you've discussed, so this is good. Rotation out of the large caps, they need to put it somewhere, and or another way to look at it, people want to start going long on the small caps, which have lagged the S&P 500 and then you take the money out of somewhere, which is the large cap tech stocks. It's just a rotation of capital. Eventually, it'll stop. What do you think?
The real money that rotates like that is slow, right? You're talking about like financial advisors and asset allocators. They're not doing that in a 5 day time frame, right? To make any kind of a difference. And there's investment committees, there's debate, there's discussion. At the margin, sure, you can have some rebalancing, but the real big money is not going to do it on day
Yeah,
two or day
that's a
three.
good point. Everybody would have to do it the same week to move the
Yeah,
markets.
of course not. It doesn't make sense. Now there was a lot of call option buying in some of these small cap ETFs, so I think there was also maybe some interesting options dynamics at the margin that were taking place. But I don't buy the rotation argument because it takes time for that transition to take place. The everybody loves a narrative and a story, right? So everyone's looking for a reason for why small caps did what they did. They've underperformed so badly, they were due to have some kind of very sharp move anyway. But to say that the reason is because suddenly long only managers got religion and said, well, the market should be more than small caps when you still have refinancing risk among the small caps doesn't make sense to me. The thing that complicates it even further, I keep saying small caps hold the key. Then I started shifting 2 days ago on Twitter X at Lee Lagerport saying utilities now hold the key. The interesting thing about this is that if small cap momentum were to stick, you should not see defensive sector rotation also taking place. Meaning, you look at the utility sector, it's actually outperforming, pretty strongly the last couple of days here. There is defensive posturing taking place. Not coincidental. From a seasonality perspective, in an election year, now is pretty much around the time when volatility tends to rise anyway. So everyone's getting hyped about small caps. Just at the time when history would suggest you actually want to get nervous about equities, period.
Before the election? Why?
Yeah, right before the election. Usually, historically, from a seasonality perspective, you look at the VIX, volatility
Right.
tends to rise in the 3 months leading up to the election.
Well, it
So you're
doesn't look
getting
like it's
close to it.
doesn't look like it's happening now. It looks like risk assets are pricing in a Trump victory. Another narrative I've heard that a potential Trump victory is good for the markets, which is why it's going up. Is that
Yeah,
what's going on?
could be. Although I will say, again, narratives. It's interesting. I think there's some truth to that, maybe. But historically, ironically, this is just fact, not a political statement. The S&P tends to do worse under a Republican presidency than a Democrat as president, just in terms of just cycles and markets, right? You end up having better returns when you have a Democrat as the president. It doesn't have to be the case this time around, obviously, but that narrative doesn't make sense to me against history.
Okay. I want to touch on a few other things before we finally close off on your outlook. We haven't gotten your real outlook yet, so we'll close off on that. Gold, lumber. Gold's been breaking out to new highs again this week, and lumber hasn't. So I'm presuming the ratio has widened somewhat again. What is your read on this indicator? What's going on here?
Yeah, and by the way, you're getting confirmation on the economic front. Look at the construction side of things. Look at the job losses that are taking place. I mean, again, what is lumber? It's a tell on housing starts. Well, housing starts have been terrible, right? Which is consistent with what lumber has been saying. There's no demand on that end, which again goes back to the lags finally starting to hit. So you're exactly right. The ratio keeps on getting challenged because it's a double whammy. Weakness on the housing start side affecting lumber, and then what I still think is defensive posturing in gold. That probably is more the real allocators that have been debating where we are in the cycle, positioning more and more into gold over a gradual several few months as opposed to small caps, right, on the risk on side the last 5 days. So that still is looking like a negative bearish signal. It hasn't mattered, obviously, right? It's been saying that for several months. I think if utilities were to keep on strengthening as lumber to gold keeps weakening, now you've got two risk-off signals syncing up. I've done studies on this. Usually, when you see lumber to gold weak at the same time, utilities against the market is strong. That tends to be a pretty strong signal of a risk-on condition, which just again means volatility is likely to rise.
The other thing we haven't talked about is the fact that the other S&P 500 sectors have been propping up the index. So if you look at just the tech component of the S&P 500, that's been going down. Okay,
Mhm.
the Nasdaq's been going down. However, the broad S&P 500 hasn't fallen because the other sectors, which up until a couple of weeks ago have lagged the tech sector, those sectors have been going up. Take a look at financials, take a look at utilities, right? List goes on and on. And so the narrative that people have been telling me that the market looks like it's ready to sell off because the tech sector's been selling off. Well, the other sectors are doing the exact reverse. They're following the small caps. Well, I don't know which one's following which one, but they're all moving up together, right? What's something driving everything up, Michael, or another just rotation narrative?
Yeah, no. So actually, it's an interesting point. The core small caps tend to have more of a value tilt from a sector allocation, meaning if you view growth as being tech, value, across the board tends to have tech in like the fourth or fifth biggest sector weighting, right? Which is where they are in small caps, is where they are also in value versus growth, right? From a style perspective, even if it's large cap. So the same dynamic that spread trade unwind, right, of large to small, I think also can apply to growth versus value. Same idea. A lot of managers have been shorting value sectors, financials being one of them, and going long tech, playing the spread. I've written about that on Investor Place before. Like 3 months ago, I made the argument that the best trade of all could be a simple spread trade going long regional banks and short tech because everyone's on the other side of that spread trade, right? So again, I don't. That to me sounds more like a narrative, right? I don't think it's a rotational thing. I think it's just a mechanical dynamic that's causing this sort of shifting of sector strength. The more important thing still remains. It looks like there's a defensive tone beneath the surface. Look, in two out of the last three times where value outperformed growth, you were in a bear market. Okay, it was the 2000-2002 period. It's also when small caps outperformed large caps, and entering 2022, value outperformed growth. The question is, this time around, if value is outperforming growth, if small caps outperforming large caps, is that going to happen in a bear market, or is this the long-awaited bull market rotation where they lead the market higher? The challenge with that narrative on the idea that value small lead the market higher is the earnings just aren't there to support it. Right? This is the fundamental problem. You still have to kind of jive it with why is it that tech has been so strong and why has there been such PE expansion? Because of earnings, because of growth. Whereas the financials, not so much.
So one of a few things could happen going forward for the equities. We could have this continued rotation, whatever you want to call it, where the small caps value stocks start to outperform and the tech stocks start to underperform, but overall the index is either slightly up or flat.
Right.
Or we could have that stop happening, the tech stocks keep going down, that drags down the entire index. Or the third option is everything reverses and we're seeing the same pattern that we saw prior to the last 2 weeks. Right? What's the most likely outcome for you?
I don't think we're going to go back to the status quo of large cap only because the cycle's changed. I mean, the Fed's going to be cutting rates, right? I mean, it's clear, and the lagged effects are hitting, so things are now changing. So I'm not saying it's a zero probability. I just think it's a very low probability, and I think the shock from the large cap to small cap spread trade makes it unlikely that you go back to that prior dynamic. Once bitten, twice shy on that trade, right? Given how extreme the move was. Um, I think the more likely scenario is you're going to have volatility. Small caps could still outperform by being down less. And from a behavioral perspective, people start to do what they're starting, what looks like what they're starting to do, which is they sell their biggest winners when faced with uncertainty, and there are only a select number of big winners. Nvidia is obviously one of them. Microsoft, Broadcom, some of these other large cap semi plays. Um, Look, taking it to the political side of it for a moment, it does seem like the Republicans have gotten some religion on economic populism. And I put out that post, which went a little bit viral. I said, unpopular opinion, a Trump presidency is actually bearish for tech. If the social mood has shifted and it's affected the Republican Party, and if Trump does win, where there's this feeling that there needs to be more opportunities for smaller businesses, there needs to be more equality of conditions for other sectors outside of tech. Tech's going to get hit, and if tech's going to get hit, and that's been what's the sole momentum driver. Uh, we'll see. If the S&P is going to be the only game in town anymore. I don't think it is.
Well, here's the bigger rotation question. Are we going to see a rotation to bonds?
I would love to see that because, as you know, that's been my personal hell as a portfolio manager of a mutual fund and two ETFs, where from a mandate perspective, when risk off, they have to be in treasuries. I'm
Yes.
actually wildly optimistic about my own funds, ATAX, Roro, and JoJo, because the cycle's changed, right? Now hopefully those rotations actually work in a real way. I think it's plausible. I think it's very clear the duration bear market is over. This hell of, just treasuries getting destroyed and credit spreads staying very tight. The unemployment rate is picking up. And it's picking up in a way that looks like it's at the very early start of a real uptrend in unemployment picking up. Unemployment picking up should mean credit stress. You look at delinquencies on the auto loan side, on the credit card side, those are picking up as well. Consumer is feeling the pain, and they're starting to actually file for bankruptcy. So at the margin, that should mean credit spreads finally do widen. There's stress in the system, gives more reason for the Fed to cut rates, obviously. And that becomes the flight to safety into treasuries at some point as that accelerates. So when we talk about bonds, it's important to distinguish between corporate credit, which I'm very bearish on, makes no sense to me that spreads are this tight, versus really high quality bonds, which people will flee to when they're nervous about getting their money back as the lender.
Is lower inflation good for bonds for the 10-year? Presumably, if, let's say, the economy is slowing down and the inflation readings aren't getting as hot as they were before, the 10-year yield doesn't have a reason to go up. That's one way to look at it. How do you see it?
It depends on real rates, meaning after inflation. So
Mhm.
this is the other thing too. I mean, you've got $35 trillion of government debt. I don't know how many unfunded liability trillions. Um, the real rate is positive, meaning interest rates are above the rate of inflation. The government doesn't like that. They want negative real rates where inflation is more than the cost of interest, because then it's eroding that interest, right? Because inflation is at a higher pace. So the answer to that really depends on where the real rate is. It's another reason why treasuries, I think you can tactically be bullish on. And I know I've been wrong on my timing on that before. I mean, when I said it back in fourth quarter of last year, but it seems to me that with the lags hitting and with the reality that interest expense at whatever it is, $1 trillion now, they need rates to go low. They need inflation to be higher than the nominal cost of capital.
Suppose the 2-year starts following. I mean, does the 10-year follow the 2-year in any
Probably, yeah, probably.
in current? Yeah, probably. I mean, the other argument is it doesn't, and then the yield curve steepens. So what's your read?
Yeah, well, I think the steepening is going to come. I mean, but it's like every single time people think the steepening is going to come, it just gets more and more uninverted for longer, right? So it's a question of sort of when that takes place. There is a scenario, let's go back to the Japan dynamic. There's a scenario where if I'm right about that, not cataclysmic, but just mechanical, risk off margin call dynamic where the reverse carry trade takes place, the Fed has to lower rates really aggressively, right? I'm talking about really aggressively to counter, right, that liquidity drain as an outs, low probability, but that could take place. So the point is, it depends on the exogenous shocks as far as how an uninversion, could play out.
Are you following the news on tariffs at all? This is something that came in on the 16th of July from the Wall Street Journal. Fresh tariffs could see interest rates stay higher for even longer, the IMF warns. A fresh wave of tariffs could revive inflation and pressure central banks to keep their interest rates higher. The International Monetary Fund warned Tuesday in its latest report on the outlook for global economy. The fund said borrowing costs could also be pushed higher by a series of elections that may lead to a surge in already high levels of government borrowing. So the Fed cut that we're pricing in right now isn't factoring in this. What's your reaction to what I just read?
While there's a logic to it, I would emphasize that the IMF generally gets a lot of things wrong. So
Okay, okay.
we never really know. But that's always a concern, right? Tariffs are a form of taxation. That's inflation, effectively. Maybe, although I always a lot of the rhetoric around this stuff is also probably more extreme than it needs to be. Um, and as much as Trump, plays that game and he plays it very well rhetorically, he's not going to be able to do all that much, I think, in a huge way. He doesn't want to also throw off his legacy, and we'll see. I think it'll be interesting to hear his speech following the attempt on his life, because maybe he, oddly enough, could be somewhat changed in the way he's perceiving things. I know that's not a popular opinion, but when you're that close to death, it puts things in perspective.
Speaking of Trump, if he were elected, he promises to cut corporate taxes to 15%. He also said a bunch of other things like he would consider JB Dimon for CEO of JP Morgan for Secretary of the Treasury. But anyway, let's focus on the tax thing first.
Yeah.
Tax cuts. What does that do for the markets?
So interestingly enough, there isn't really a lot of evidence that tax cuts actually are beneficial for markets. So let's go back to that point about when you have a Republican president, the S&P tends to historically actually underperform than versus when you have a Democrat.
Mm,
That's the platform for Republicans is lower taxes.
yeah,
So
good
while on the
point.
surface you'd think, right, that now what I would argue is that maybe the lower taxes, if it's targeted more towards small and mid-sized companies, that might actually usher in that relative bull market in small caps against large caps. Right. I think the taxation side would most impact the companies which are smaller, which have razor thin margins and which have to deal with higher for longer rates. But as far as the broader market, it's just not clear.
I remember when Trump was president the last time, I mean, there was a broader bull market for equities, but every time he announces fresh tariffs or new tariffs on China or an escalation of existing tariffs, the market goes down on that
Yeah,
news.
yeah.
Markets just don't like tariffs. They react more violently than any news on taxes. So that to me is another risk. How do you see it?
Yeah, well, I think algorithms don't like that. I don't know if markets care. Right? It's like
Algorithms, yeah,
it's just
okay.
machines at this point. They're just reading things. Oh, whatever he says. Okay, we're gonna hit the buy button, sell button, and just algorithmically program that. Again, just because it's happened in the past doesn't mean it's going to continue to happen. I'm hesitant on a lot of these narratives until we actually see it play out.
One final piece of news I want to bring to your attention. So, I'm reading online, $9.3 trillion in U.S. debt is set to mature within the next 12 months. And when that does, they're going to have to refinance at a higher interest rate. This is a narrative that's been talked about a lot, but it's finally starting to happen next year. Broader implications for the bond markets.
Sounds like they need to crash stocks to save bonds, which is something I have argued for like a year that is probably how this ultimately plays out, which is the forcing of the flight to safety trade. If you got all this debt that needs to be rolled over, it needs to your point, it needs to be rolled over into lower rates. So how do you get lower rates? Either economic recession, right, or an event.
Okay, so you have U.S. debt maturing. They're going to refinance at presumably higher rates. Well, that's obviously bad for the U.S. Treasury. They're going to have to pay more in interest payments, but that's good for bondholders, is it not? Is that good news for like you're getting a higher yield? Am I just reading this? Am I reading this correctly?
Well, no, because again, it depends on sort of where the demand is coming from, right? I mean, if the yield drops, then as a bondholder, you like it. If the supply overwhelms the demand, the yields are rising. You can buy into it when those yields have risen, but if you already hold it, you're actually suffering principal loss, right? Yield up, price down. But again, it's not me trying to be a perma bear or just scare people. It's just like mechanically, how do you get rates to fall aggressively just in time for that rollover? You have to cause fear.
Okay, so bottom line, your outlook, it's mid-July, middle of the year. Let's do a mid-year summary of your outlook. So gold going forward into the rest of the year. Do we have more room to climb, you think?
Yeah, I think so. I think the gold move, I think, is very early. I don't see the optimism that you typically see at tops. I keep going back to uptrends are built on skepticism, and there's still a ton of skepticism.
Okay, so the Russell 2000 false move, you said. So what does that mean for the broader S&P 500? Has the S&P 500 topped?
So I think it's a false move in terms of the absolute movement higher. I think it could be a real move on a relative basis, meaning small cap to large cap relationship could turn higher, which means that if you have a bear market or a decline, they'll be down less as Nvidia and all the other big AI tech names fall faster.
Yeah. And for the longest time, people were telling me, well, it's time to get into small caps because they've lagged. That's a good value play.
Yeah.
It's finally moved. So I wonder if people are going to take the reverse trade now. They're going to start shorting or getting out of that trade. Or is it too late? Basically, my question is it too late to get into small caps if you believe that narrative?
No, I don't think it's too late. Purely because again, it's people forget small caps have been lagging large caps since 2011.
Yeah.
This is not new. I mean, if it's real, that's what I'm saying. It's a multi-year cycle of relative strength and outperformance. I think a lot of people like me want to see small caps work because it's been really hard to beat large caps. I mean, there was a stat prior to all this, from a week and a half ago, something like 21% of the S&P 500 was beating the S&P 500, which is the lowest percentage of stocks in history, where you saw, relative strength, of the vast majority of stocks beneath the averages. So a lot of people want to see small caps, see broader participation because it becomes a lot easier to play catch up against the S&P. I just caution on the idea that it almost seems too obvious right here, right now, and everyone's talking about it.
And finally, 10-year yield. Is that heading back towards 5%?
I think it's more likely than not the 10-year yield will keep on falling. And I go back to, I think if you're going to have that volatility, if I'm right, finally around this, the Phoenix, the flight to safety and treasuries, which I want to see for my own strategies, then yeah, I think you're going to see yields drop aggressively at some point, then maybe come back up, right? But you'll get a sequence there where there's a flight to safety into treasuries. And when that happens, by the way, I promised you this when we got together at the New York Stock Exchange. I was going to have you had gotten me this beautiful ice.
Oh,
Okay, when we met as a token of your appreciation for coming out to New York Stock Exchange. I'm in a 2 or 3 day. I think I'm in a 3 day fast currently. I forget. I ate Tuesday, Thursday. So no, I'm in a 2 day fast. I will have this later. If I drink this live on air with you, given my fasted state, we will go viral because I will probably pass out.
We don't want that. We'll have to call the we'll
I
have
mean,
to call
viral
the
is good, but I
ambulance
don't want to
live.
go viral like that. I mean, that's like,
Yeah, that's there's good viral, there's bad viral. We want you alive. We want you in good health. But yeah, I'm glad you kept that bottle. We'll drink next time when the treasury start moving down towards 4%.
I can finally
Um,
afford it at that point.
no, you're doing great. Thanks a lot for your help today. Thanks for educating us. Tell us where we can find you.
Yeah, I appreciate it. On Substack, leadlagreport.substack.com. On X at Lead Lag Report, YouTube at Lead Lag Report, Instagram Threads, yes, Threads as well, and LinkedIn, Michael Gayed. I appreciate everybody that appreciates David. And if you don't already subscribe to David's channel, you're out of your damn mind. Make sure you hit that subscribe button.
Thank you for that. Thank you for that free plug. It's better. Oh, it's always better than me doing it. But okay,
You
yes,
know
please
my address
subscribe.
for the check. You know my address for the check.
Please subscribe to me. Please subscribe to Michael Gayed. Links down below. We will be back next time. Thank you, Michael.
Appreciate it.
Thank you for watching. Don't forget to like and subscribe.